Welcome to this brief presentation of a theory of return-seeking firms. This presentation walks through a paper of the same name that I wrote a few years ago with my co-author Brendan Markey-Taylor, and it is intended to show why adjusting the firm objective function helps solve one of the key puzzles of the simple economic models of supply and demand, namely the rising marginal cost or the upward sloping demand curve. So what's the issue at hand that we're trying to solve? Well, the puzzle is that there's no such thing as decreasing returns to scale. And Miles Kimball has written about it repeatedly, and here's a blog post link to one example. And on the right here, this graph really makes it clear. So on the right, we're looking at the cost curves in the standard economic model, the ATC, the average total cost, the AVC, the average variable cost, and the MC, the marginal cost. And the marginal cost is just the cost of the next unit of output, the next Q unit of output. And so you can see there are economies of scale in production because the average total cost falls as output increases, but then it starts rising. Okay, so you get to that point after increasing returns to scale, and you start producing on the decreasing returns to scale part. And that dashed red part of the marginal cost curve is what's known as the supply curve. It's the rising part of the marginal cost curve above the average variable cost. And the argument here is that producers in the economy produce their goods and services on that rising part of the marginal cost curve. And hence, when you horizontally summate all those curves of producers, you get a market supply curve, which is upward sloping. The problem here is that if you're producing beyond the minimum of the average total cost, so that's that dashed red line above the ATC line, what you're doing is you've sort of exceeded all the economies of scale that you've got. And what you're doing is producing for not the minimum cost, but a slightly higher cost. And the critique is that why would you keep producing that much output at a higher price when you can simply duplicate your whole production and have, for example, half Q being produced at two different firms at the lower average total cost per unit and the lower unit price. So why would you produce up here when you could produce down here but have two different facilities? And so that's the replication argument. If you can duplicate the factors of production, the inputs, then you can create an identical copy of the production process, and you can always double output at the same price. And the more competitive a market, the fewer firms there are. So we can think of a case where there might be 100 firms in a market and the market output rises 1%. Well, either all producers can increase their output 1%, or you could create a new facility that adds that 1% at that lower cost, rather than having any producer face the upward part of the marginal cost curve. So you can think about it like this. Here's a really simple example. The red line is the demand curve at a price of $1. So this is an example firm that has no price effects, and the horizontal axis is the quantity of output, and the y-axis is the cost and price in dollars. And you can see that, well, if you want to expand output from 10 to 20, if you're doing it on the rising part of the marginal cost curve, it looks like going from A to B. Okay, you've got to pay more per unit, so you're paying $17 to produce 20 units rather than 8 to 10, so you're paying more than 80 cents per unit in this case, and you're getting only 50% more profit for more than twice the input cost. So your return has fallen from 25% to something like 18%. And the replication argument says, well, no one's ever going to do that, because what you could do instead is set up two production units like A and produce 20 units of output for $16 cost and get $4 profit. Why would anyone forego that option and produce on the rising part of their marginal cost curve? That's the mystery. And I think, it's actually really important to resolve this and to isolate why economics ended up like this. So the big difference between economics and, for example, finance is that in economics, that rising marginal cost curve and the producing on that upward sloping part comes from the assumption that firms are profit maximizers. So pi q is profit as a function of the output q here in this first equation. And a profit is just the dollar difference between revenue and cost. And as we saw on that last graph, well, it's not obvious you want to maximize the dollar amount of profit if your costs go up dramatically. You've got to have that in reference to the costs. And so in financial management, they typically think about investors, and of course all firms are making investments. They think about the maximization of a risk-adjusted rate of return. So in this case, it's the profits, same equation on the numerator there, per unit of cost input. So what's the return on my cap? If I put $100 in, do I make 5% or 10%? Okay. So that's the big difference. So why don't economists account for those costs? And the answer is that the models usually assume this really weird thing called the short run, which is a period of time so short that not all inputs are variable. So some inputs, like capital, are fixed. So what you're actually doing looks more like maximizing the rate of return on whatever input is fixed. You're maximizing the profit per unit of this fixed input. And in this case, we call it K bar, like a fixed amount of K, which stands for the stock of capital, for example, the number of buildings that you have. And so, that makes sense in some kind of weird way. But what if these costs in the numerator here could also be spent not just on maximizing the return on this amount of capital, but maximizing the amount of return on all the costs? So what if all costs are considered potential capital inputs? And that makes sense, right? Because unless there's some restriction on what you can spend on, you can duplicate your fixed costs with those expenditures rather than just adding variable inputs to your fixed costs. And so the return-seeking firm idea is to really just recognize that every input cost you add onto a fixed amount of capital comes at the opportunity cost of spending on more capital. Okay, which is, seems quite intuitive and logical, but it turns out to be a very, very important assumption. So I would refer you to the paper to work through all the results, but I'm going to summarize here what changing that assumption does to our understanding of firm behavior, or the firm supply curves or market supply curves. And in this case, typically the profit maximizing firm produces where the marginal revenue equals the marginal cost, right? So the last unit of output, the extra revenue from getting it, equals the cost of that final unit of output. But the return-seeking firm, you get a quite different, maximizing point, where it's actually where the average total cost times the marginal revenue equals the marginal cost times the price or the demand function. So quite a different result there. And what does that mean in practice? Well, it means a few things. It means that prices must be above average total costs. Okay, so that dashed part of the supply curve below average total cost, just wait for a car to go past, it doesn't really exist as part of supply, except in very unusual short-term circumstances. Okay, production only takes place in the range where prices exceed average total costs and where average total cost exceeds marginal cost. So this blue range here is where the price and output combination must be, which is very, very different because in the profit maximizing theory, price and output combinations are always on this dashed rising marginal cost line. So quite a different result there. So the fact that production always takes place on a downward part of the total cost curve, the average total cost curve, means that for any production to take place, there requires some economies of scale. That makes total sense because of the replication argument. Because if there's no economies of scale from producing 2 units rather than 1 unit at your facility, then you just build a lot of different 1-unit facilities, right? You don't vary output at any particular business. Every business produces 1. In fact, we just are in a situation of home production. There's no specialization because there's no economies of scale. So what we've done here is we've resolved the replication argument to fit with the common sense view, and we've also given a sort of fundamental economic reason for the existence of firms in the first place, and that is to capitalize on economies of scale. If there are no economies of scale, you don't need a firm that specializes in producing one type of good. Everyone just produces the goods they need at home, the one item when they need it, because there's no benefit from producing 2 items. That's super important. And so what we do is we end up with these quite unusual supply curves. Okay, if the firm is a price taker, for example, if their demand curve for the individual firm here, PQ, is flat, okay, they always just produce at the cost minimizing point down here, the minimization of average total costs, because that maximizes the return on all your costs. Whereas a profit maximizing firm will produce a little bit more where the marginal cost is rising. So we've sort of explained why you add more capital to production rather than just vary output with this type of model. The other interesting thing is that if a firm is a price setter, so that PQ, that solid black line downward sloping here, is the firm's individual supply curve, then a return-seeking firm always produces less. So the Q star is the return-seeking amount, maximization of a return-seeking firm, whereas the P and the QP are the output and price combinations of the profit maximizing firm. So a return-seeking firm always produces less per unit of capital. Does that make sense? Because these curves require a fixed amount of capital than a profit maximizing firm. So they're always, relative to a profit maximizing firm, they underutilize their capital. In many ways, they actually invest more in capital relative to output. So it's a very different way of seeing things. We can also think about competition through this lens, and it's a little bit different to how you analyze it in profit maximizing world. In that world, you all sort of share a downward sloping demand curve, but I think the better way to view that is to think of firms facing firm-specific demand curves where their slope represents the degree of sort of market power. So we can see here PQC as a competitive market demand curve, where if I try and raise prices, I can sell a lot fewer. Whereas the PQM, I raise prices, it's not having such a big effect on my output, okay? Like on my sales. So you can analyze competition through the slopes of the firm demand curves, and you'll see that in more competitive demand curves that the quantity supplied is much higher than in monopolistic. And when I say the quantity supplied, I mean the quantity supplied for a given stock of capital. Okay, so monopolistic firms, you could argue alternatively, have a lot more capital per unit of output than competitive firms. And so back to that supply curve, what does it look like? Well, we can see a derived supply curve here, S, this slight downward sloping line, and we can see the effect of the change in demand from PQ to PQ delta, the dashed line. And the return-seeking firm that faces this grey average total cost curve that has a lot of economies of scale to go can see a positive demand shock and find it return maximizing to reduce prices and increase output. So you can get a downward sloping supply curve, and that's more likely to be the case the more economies of scale remain in the capital. So the steeper the average total cost curve falls, the more likely that the resulting supply curve in that type of industry is downward sloping. So positive demand shocks can reduce prices. So because each unit of capital, the price goes down. Even though your firm's own demand, you're still price sensitive. There's a slope here on your own demand. You're still better off to lower prices to capitalize on that demand and get even more output. So I think that's a kind of interesting way to resolve the replication argument and one of the big puzzles in supply and demand. And it was a simple tweak to just account for the fact that all input costs can be capital costs. And that's the full opportunity cost. And once you take that into consideration, you get a very different type of supply side behavior from firms. So thanks for listening. Here's a link to the paper and a free version of it as well, and I'll put a link in the description. Thank you.